John, pharma and safety auto components have been themes that you've talked quite a lot about in your portfolios. More recently, you have mentioned calling off the dogs on utilities and the renting of banks. Can you explain these investment plays and where you are with them?
Yeah, the renting of banks refers to my long-held view that bank stocks are not for investment, they're for renting. Handle with care, but don't buy and hold. There are one or two exceptions to that, but they are exceptions. And so our latest rental period for holding bank stocks lasted about 18 months. And we started to sell the banks, in fact, in the spring of this year. And the reasons for that was that they had re-rated. And they had re-rated from distressed valuations in 2012 when you had the existential crisis of the euro, which incidentally I don't think has gone away, it's just in abeyance. But you did get, distressed prices, very, very low price to book for bank stocks, and there was a trading opportunity which for us lasted anywhere between 12 and 18 months. For us that's over. They've re-rated. They've re-rated to an extent that I believe factors in a healthy return on equity, and I don't think the whole sector is going to generate a healthy return on equity. Some will. And it also factors in earnings growth, and I don't see earnings growth from 90% plus of European banks. At this stage, I do not see a return to earnings growth because I cannot see the demand for loans in what is a recessionary double dip, triple dip continental Europe.
Turn of the year, you predicted that Spain, Greece and Portugal may well be surprise economies in Europe in terms of growth. This has to a large extent come true. Have you been able to find stocks to take advantage of this?
We have sort of cherry-picked in Southern Europe. I mean, I talked about bank stocks being for rent. I mean, we had a one-night stand in investment terms with Greek banks. I mean, it lasted a few months only. And we cut and run because I didn't really like the behaviour of some of the management, quite frankly, when I met them. And I didn't like the extent of the compression of the sovereign yields, and this is an important point, in Southern Europe. So you've seen a dash for yield again. I think that usually ends badly. And you saw a great compression in the periphery of sovereign bonds. Spanish yields lower than US Treasuries. Didn't like that. So we actually reversed from the periphery at the time we were selling bank stocks in Q2 of 2014. That being said, we have stayed in some select names. I still own Bank Inter, which is I see as a challenger bank in Spain, and an extremely well managed bank. But I think the time for the periphery, let's asset allocate to the periphery trade, I think that's over.
You mentioned recently you think we're moving towards the end of a bull market in Europe. We've seen some macro investors moving out of Europe in recent weeks. Not to draw you too much into a macro comment, but where do you think we are in the cycle?
I think the macro stinks and is getting stinkier. Maybe that's because I've spent a week in France and a week in Italy this year and they're a mess. But in 27 years of doing this, I keep repeating, please don't go too macro to anybody, not just me, because actually that's where I've made my biggest mistakes, is go too macro. It's all too easy to throw babies out with bathwater in Europe. Look at the macro, it's grim, it's terrible, it's getting worse. But Europe is home to domestic stocks, banks, industrials, cyclicals, and non-domestic stocks. Europe is home to global champions who happen to be listed in Europe. And what I believe the task is that you can stay in Europe, but you don't have to be in European-centric names. And that's really what we did up until 2012. We were in the sort of global names, the staples, the pharma names. We're still in pharma. But we had very little to domestic Europe. Then we came back to domestic Europe. And what we're really saying to clients is, as of March 2014, it's been time to sell back down domestic Europe and hold more of the global names. And that's precisely what we've been doing. So I would urge again Open the Wall Street Journal, open The Economist, look at especially British television and panic about Europe. It's the wrong response. Our job is to go out there and find companies. The great thing about the panicky and the horrible macro, and France is a mess and Italy's a mess and the rest isn't much better, the great thing about that awful macro narrative is that's what provides bottom-up bargains.
The trust is predominantly invested in large cap. Do you find many opportunities in the smaller size names?
We do. I mean, we won't go above typically 10% small cap being less than €1 billion market cap. But small to mid cap, I'm very happy to take the trust if the opportunities show themselves. I'm very happy to go up 20, 25% in mid cap, certainly, absolutely. And the trust lends itself to that. The trust being closed end, I can buy, for example, I met last week for the third time this year the management of one of our holdings. It's 3% of the trust, Veidekke in Norway. Most people haven't heard of it. That's quite a good thing. Although you hope by the end of your career most people have heard of it, because then you've made money. But Veidekke at 3% of the NAV and a big 5% plus yield is a little construction stock up in Norway. Now, that's the kind of thing stock that you don't buy in a large open-ended book of business, because you can't, because of the liquidity. Henderson European Focus Trust is a nap for that kind of idea, that kind of special situation. Because it's closed end, my position will not get diluted by subscriptions, nor would it be inflated by redemptions, which you can have in the open-ended world.
John Bennett, thank you.